Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Thomas DiFazio. Thomas is a director and research analyst on the firm's asset allocation team. We're going to go through all that, but first, Thomas, how are you doing today?
I'm great, Ross. Thanks for having me on today.
Thrilled to have you on. Always good to talk through, how the firm is actually positioning assets and thinking about sector and asset allocation for client portfolios. So let's start on the sector front. You made a couple recent changes, in the last few weeks or months. Could you talk through those for me?
Yeah, absolutely. I'd be happy to. First and foremost, the changes that we decided to make were to some of our underweights as well as our neutral weights. Our sector changes were that we decided to downgrade consumer discretionary from neutral to underweight, while also upgrading consumer staples. Really what the logic here is that after you had that 3Q GDP print, consumption was the strongest contributor and a very big driver of that impressive number in the third quarter. And we took pause and are like, is that as good as it's going to get? Can this high quality type of growth be durable? We're of the belief that the consumer faces a lot of headwinds. Two of the big ones being that the consumer personal savings rate is depleting and is very well off the pre-pandemic highs, and we believe has now been fully exhausted and is now normalized. The second one being, we also think interest costs are going to weigh more on the consumer over coming months, and we think as a whole that is just going to take some wind out of the cyclical sales, and consumption could take a hit here. With that logic, the downgrade to consumer discretionary made sense to us, and then allowed us to also upgrade consumer staples, which would be the more defensive pairing with that slowdown there.
Right. So staples are kind of must-haves for households, whereas discretionary items, often bigger ticket, maybe service oriented, and are the first things to get cut from people's budgets when things get tighter. So makes all the sense in the
Exactly.
world. And I wonder if that sort of framework and thinking informs what you all are doing in your asset allocation portfolios as well, which in some ways is kind of zooming out even further and looking at other asset classes, bonds, commodities, cash, et cetera.
Yeah, absolutely. It's a great question. Overall, we remain defensive in our global asset allocation framework, and we actually did make some changes recently. We are downgrading large cap value as well as small cap core, and we're upgrading our exposure to large cap core. And if I were to summarize what those changes mean, it's when growth is scarce, you go for growth. Taking down large cap value and small cap core enables us to get a little bit more exposure to the growthier parts of the market without making a full-on embrace of the growth corners as a whole.
That makes a lot of sense. But we're sitting here, we're recording on a Thursday, so broadly getting more defensive on the idea that this third quarter growth is not sustainable and there are macro headwinds. And yet, and this question could age like milk, but as we're sitting here today, we're in a bit of a rally on the idea that the Fed is done hiking, yields have plummeted a bit off their recent highs, and it's spurred this risk on rally in markets, including a big rally in small caps and some of the lower quality stuff. So I'm curious if the recent rally, and knowing that it's only been a couple of weeks, changes how you all are thinking about the framework over a longer period.
Yeah, absolutely. It's a great question. The cooler than expected CPI reading was very welcome and the market loved it. Some of the most impressive readings that we saw yesterday was that the S&P, the percent of stocks within the S&P posted, I guess I should say that 40% of the S&P 500 posted a +2 standard deviation move. So that's a very strong surge. And then if you go down the cap scale to the Russell 2000, you'll see that over 50% of the Russell 2000 posted a +2 standard deviation move. That is some frenzied accumulation and could be the catalyst of a larger leg higher. That being said, we are still missing some data points. Overall, the net 20-day high data, which we like to queue off of to see about if there's broad participation from all corners of the market, is still lacking a little bit. You did see some improvement in some of the more risk-on factors like high beta versus low beta, small caps versus large caps, but this is just a couple days, and we are trying to keep the bar elevated before we decide to get less defensive and get more constructive on the market. As a whole, small caps, we believe, still deal with some pretty serious fundamental issues, and really we would just, one of the biggest ones is just interest costs. In this current environment, the cost for capital is elevated, and we believe that weighs very heavily on the smaller contingents of the equity market. And as a whole, we struggle to see the durable cyclical bid emerge until some of these fundamental blemishes can lessen.
Yeah, as you mentioned, since rates started rising and since the Fed started hiking, small caps have dramatically underperformed, and there are still a lot of those headwinds that really aren't going anywhere. So we'll need to see some follow through. But again, as you mentioned, still nice to see some risk on and a soft CPI report after all we've been through. So we'll have you back on to talk about it again. That's for sure. Thomas, thank you so much for the time today, and have a good weekend.
It was my pleasure, Ross. Thanks for having me. Enjoy the weekend.